Broadcasting from the business capital of the world, this is the Podcast Business News Network. So I'm going to ask you a question. I want you to take a moment to let it sink in, maybe answer the question in your mind. Are you doing everything possible to maximize your tax savings, your financial situation? Are you squeezing every dollar out of anything that you're doing, especially when it comes to taxes? Are you even aware? Is this one of those things that you prefer not to talk about because you're concerned that you're probably leaving money on the tax table? We're going to talk about that today, especially with it being a new year. Perfect time to maybe make some course correction in your financial situation. This gentleman has been working for decades in the financial world, making sure people are financially sound. He and his team get it done in all different aspects, as a matter of fact. Company's called Jacques Financial. Jacques, our professional of the year, joins us today. Joe, how you doing?
I am doing wonderful. Another new year and a lot of, we all make predictions of how we can improve ourselves. And I'm going to give you some ideas this year, through this podcast, of different things that you may not be thinking of that could save you a lot of tax money and put you on some financial strong footing.
Love it. This stuff I find intriguing, and I know personally there's always something I'm missing. There's always something that maybe, a financial advisor may miss because, and I'm not saying they're not doing their job. Maybe they don't have all the info from the client. And I'm sure you encounter that from time to time. Would you say so?
Oh, absolutely. Absolutely. So it's just a matter of nobody is able to know everything. So these are kind of just some specific tips for if you're working, what are the things that you should be doing? If you're retired, what are substantial tax savings that a lot of people don't know of that could really help you save a lot of tax money? Where
do we begin?
Okay, well, let's just go over some of the basics. So if you're an employee, some of the basic things that you have to have is your employer pretty much has a 401k plan, which is usually your best savings vehicle for retirement. This year, the numbers have gone up. If you're under age 50, you can contribute as much as $23,500. If you're over 50, you can use a catch-up and contribute as much as $31,000. And it's the best way of savings. Let me give you a quick example. Let's say you're going to contribute $10,000 to your 401k plan, and your employer matches 5%. So you contribute $10,000. You get a deduction on that on your tax return. So it's really netting you, only costing you $7,000. Your employer is going to contribute $5,000 to your account. So you contribute a net of $7,000, but your account is now worth $15,000. What a wonderful way of saving for retirement. It's the number one vehicle for savings for retirement.
And I don't want to use a cliche, but it adds up very fast, once you're investing it, right?
Oh, very fast. I mean, it's not unusual I'm talking with people that have been working for 30 years and have well over $1 million in their 401k plans.
Gotcha. And I'm intrigued and wasn't aware of you called it, if you're over the age of 50, the catch-up where you're allowed to take it up to around 31K?
Correct. Yeah, it's an extra $7,500 that you could get to contribute. And this year, there's some additional savings if you're age 60, 61, 62, 63. They give you even additional amounts that you can save. But that's something that if you fall into that age bracket, you can even save a little bit more.
Why don't we, while we're on that end of the scale in terms of age, why don't we look at that for a moment? If you're 60 and above, what are some things that you can be mindful of to take some tax savings or just save in general?
Well, this is a big one because right now the standard deduction for taxes have increased again this year. So without having to prove anything on your tax return, if you're married, you get a standard deduction of $30,000. If you're single, you get a $15,000 deduction. And if you're over 65, you get an extra $1,600 a person. So a married couple over 65 gets a standard deduction of $33,200. Significant, because what's going on right now is that, people that have been in their house for a long time have paid down their mortgage quite a bit, and you have charitable contributions. Now, this is the big thing right now. Can really save your listeners a lot of money. For people that are retirement age and are age over 70 and a half or older, there is a vehicle called a qualified charitable distribution, called a QDC. And what that does is that anybody that's usually in that bracket that has paid down their house, doesn't have a lot of medical bills, if you give to charity, let's say you give $10,000 to charity, that $10,000 is not tax deductible now, because your standard deduction is so great that you can't do it, because you don't probably qualify for medical because you have to exceed 7.5% of your adjusted gross income. Your taxes are limited now because of assault to $10,000. You don't get any miscellaneous tax deductions anymore. So you're charitable. If you only contribute $10,000, you're not deducting any of that charity anymore, because you get the standard deduction. Now, where it comes really important for older people is that if you're 70 and a half or older, you can do this QDC, which means that you can contribute from your IRA right to the charity. So normally if you take the money out of your IRA, and if you're 73 or older, you have to start taking money out of your retirement accounts. But when you take this money out, it's going to be taxable to you. So if you do a QDC, which is this qualified charitable distribution, you can take your required minimum distribution, direct it to a charity. Let's say you give it to your church or a cancer foundation or whatever, and it goes directly to that. That money coming out of your IRA, which normally would be taxable, under this QDC is tax-free. And then, because you can't deduct it, you balance it out. But if you just go ahead and take money out of your IRA account, your required minimum distribution, you have to pay taxes on it. Let's say it's $10,000, you have to pay taxes of $3,000, and you use the standard deduction, you don't do the QDC, you end up paying taxes on $10,000 that you can't deduct. By using a QDC, you can pull it out of the IRA account, give it directly to the charity. It's tax-free. You have contributed $10,000 to the charity, and you don't have to pay any taxes on it.
Wow. Gets a little detailed, but many of us, I'm sure, don't know anything related to that, and moving it directly from the your investments to the charity. What's the maximum that you can donate to charity?
For each year, you can do a QDC. Right now, it's $105,000 a year if you want to be that charitable, and people are.
Wow.
But that's the key. Anybody that is retirement age that has to take out a required minimum distribution, they would be foolish if you're just giving it to church or a charity directly out of your savings. You have to take it out of your IRA account, and then it becomes completely tax-free, and you still make the contribution. It's the best tax savings vehicle a retiree can do.
So just to reiterate, because this sounds very important, if you're going to make a charitable, a sizable charitable donation, don't take it out of your savings, take it out of your investments. That's what I'm hearing. The bottom line here.
If you're age 70 and a half or older.
Gotcha. Okay. Wow. Popped in my head. I'm going to throw it to you. I know we're going to pivot for just a moment, but the FinCEN, I think it's called. You need to, if you have a business, you need to report your corporate transparency. I know that there was a January 1st deadline, then it moved. What's the latest on that now? Because I know there was some court issues with that involving the IRS and others. Do you have an update on that?
Yes, I do. It's kind of a bouncing ball. The IRS required anybody that had a limited liability company, an LLC, was required to report owners and who all the owners of the LLC. Well, a court stopped that. Then the court overruled themselves, and then the court overruled it again. So right now, there is no requirement to report the ownership of those businesses, but stay tuned. So right now, there is nothing that requires people to report on the LLC. And
is that something that a financial advisor, accountant, your financial person can take care of for you? Because I've talked to friends and they've got notices from their accountants who said, no, here you go. You got to take care of it. I don't do that.
Most accountants don't take care of it. And the reason why, and we're the same way, is that there is a $5,000 fine if you do it wrong. So most accountants are saying, hey, this is a legal issue. And what we do for our firm is that we refer you to a law firm that will file that for you. But the liability is the reason that most accountants are backing off on it, because if they do something wrong, they don't want to be hit with a $5,000 fine.
What a great country. I don't do politics or anything, and I see there's a place for transparency, but they make it so difficult. When I first got that notice in the mail, back in the fall, I went online. I'm looking. There's a video that walks you through it. It looks reasonably challenging in terms of how the form needs to be filled out, the information. They don't make it easy. That's where I'm going with that. That's just my personal opinion.
Well, it's not easy, and but everybody that has a limited liability company, whether it's business or not, is still required.
Yep.
Well, not anymore because it's on hold. That doesn't mean it's not going to be reactivated or not, so you have to kind of stay tuned for this.
All right. Pivoting back to saving in terms of taxes. What else do you have on your radar?
Well, let me just tell you the biggest issue that most of my clients ask me about that is totally misunderstood, which is gifting money, let's say, to another person, or most of the time to kids. You hear that you can give away, and this year it's increased to $19,000, that you can give money to your kids, less than $19,000, and you don't have what's called a gift tax return requirement. That is the most confusing things to people, because the assumption is that if you give more than $19,000, you have to pay you have to file a gift tax return, and you have to pay taxes. That's totally incorrect and the wrong assumption. How that works is, you'll get a kick out of this, is that every individual is allowed to give away right now, during their lifetime, basically, I think it's like $130,000. I'm trying to get the exact amount on that gifting, but it's I'm sorry, 100. I said that wrong. Roughly a little under $14 million during your lifetime. So you can give away $14 million, and you don't have to pay taxes, and your person you're giving the money to doesn't have to pay taxes. What the gift tax return is nothing more than accounting for how much you've given over your lifetime. Has nothing to do with taxes. So let's say that you give your kids $200,000 to help buy a house, and you have to file a gift tax return. You have, the amount is like $13,999,000 that you can give away, to other people. So let's just say, let's just round it out to $14 million. So the gift tax return is you start at $14 million, you subtract $200,000, so now you have $13,800,000 yet to give away during your lifetime. So the gift tax return is nothing more than an accounting of how much you've given away during your lifetime or in debt. It has nothing to do with how much taxes you owe. So that's a very misunderstood concept that I just wanted to make sure everybody was clear on.
Joe, I'm going to ask you to repeat that, encapsulate it one more time, because that is I've never heard of that before.
Well, let's go over it again. You can give away $19,000 and you have no filing requirement. But if you give more than $19,000, you have to file a gift tax return. And through my example is that if you give your kids money to buy a home, $200,000, you can give away a little under $14 million during your lifetime, and it's completely tax-free to you to give it away, and whoever receives it is also tax-free. The gift tax return is simply an accounting to keep track of how much you've given away during your lifetime.
Wow.
It has nothing to do with the amount of taxes that you might have to pay because you've given money to other people.
This is huge. When you think about what you may have given your children, buy one a car, do this, do that, is it a running tally that you keep track of?
If your gift during any annual year to a person is over $19,000, then it's a running tally.
Got it. Okay, so for example, let's say you gave one of your children, I don't know, $10,000 toward a car. That wouldn't come into this category at all.
That's correct. That's under the $19,000 rule. There's no filing requirement for you, and the kids don't have to report the $10,000 on their tax return.
Amazing. Good stuff. Good stuff. What else you got for us?
Well, let's just look at my notes that I have. So from a tax savings, and then basic things, we've discussed this in previous shows. Everybody needs to get a will. So this beginning of the year, it's a good time to go and get a will. And you kind of looked it up on the internet and said you can get a will for $100 through wills.com. So nobody should have an excuse of not having a will. And then you should also review your insurance, such as life insurance. The younger you are, the more insurance you need. The older you are, the less insurance you need because you have assets to take care of that liability. Home insurance, an umbrella policy that protects against your liability of somebody suing you. This is something that you need to talk to your car and auto insurance guy to know a little bit about. But those are important foundation type of vehicles that you really need to do. Now, if you're working, there is a couple of other things besides the 401k plan that you need to focus on that's very important. One is called a flexible savings account. Hopefully your employer has that. Mm-hmm. So if you have kids and they're going to get glasses, they're going to get braces, you really can't deduct that as an itemized deduction because you have to get over 7.5% of your gross income. You can contribute to a flexible savings account each, if both you and your wife are working, $3,300 a piece, or a total of $6,600. And so if you have braces or glasses or co-payments, you can contribute with pre-tax money. So you don't. So you get a deduction when you do all of these medical expenses. Which, if you contribute $6,600, you're going to get a deduction of a third of that, let's say, and it's going to save you like $1,500 to $2,000 in taxes by doing a flexible savings account or an HSA, which is a health savings account. You can also put money away towards medical expenses, and they have sweetened the pot for health savings accounts in that if you keep contributing this $85.50 a year into your HSA, that's going to continue to grow and grow and grow, and you decide to not use it to pay off your medical. Now they've made it sweeter in that when you retire, you can roll over that entire account into your IRA account, and that will then enable you to contribute more to your retirement accounts.
Wow. You mentioned something before that triggered something in my mind. Quick question. Let's say somebody, and I had a conversation with a friend on this one, didn't have the answer, owns an LLC, thinking about buying a new car, and had this thought, well, maybe I should just register the car under the business, and, because the car is used for business. Are there advantages to that? Does that make sense?
Well, you have to be careful there because a lot of people think because you have a business, you can register the car in the name of the business and it's fully deductible. Totally wrong, and you're going to be hit with fines and penalties. Basically, how you deduct a car, whether you register it through a business or your own name, is basically you look at the total usage of the car compared to your personal usage. So let's say you put 20,000 miles a year on the car, and you only use $3,000 3,000 miles for business. You can only deduct 3,000 divided into 20, that expense, or roughly about 15% of the car for actual business use. So even though you buy it for, in a business setting, you can still only deduct the actual business use. You can't deduct the personal use.
Gotcha. So it sounds reasonable to, if you're thinking about anything even related to that, to register it personally and then just deduct, what you use the car for when it comes to business, and instead of cross-pollinating between your LLC and your personal.
Correct. And right now, your business miles, which is phenomenal, this year, your business miles, you can deduct 70 cents a mile.
Wow.
For every mile you do. So if you do 10,000 miles, you times that by 70, and basically you can deduct like $7,000, on your tax return.
Amazing. Is that a change this year?
Well, the mileage rate keeps increasing every single year. Just a couple of years ago, it was like 54 cents a mile. Because things are more inflation and everything like that, the IRS has really kept up to what an actual car expense goes with insurance and paying for a car and gas and oil and maintenance. So they calculate that now at 70 cents a mile. So you can get a deduction for every mile you drive for business by, for 70 cents every mile you drive.
Gotcha.
Pretty generous, I think.
Amazing. Great stuff today. Got to tell you, Joe, a lot of things that many of us don't realize. And thank you for the update. I don't even know what it's called, the Fin whatever, in terms of
right.
What's your final question? Real toward the end here. I don't want to run over. What's your feeling on that? Do you think there will be any kind of ruling anytime soon?
Well, I think it's going to go to court and everything like that. The bottom line is I think the IRS just wants to see if anybody's hiding money. That's the whole purpose of this whole thing, is to try to see people that are trying to hide ownership and trying to see if people are not paying their fair share of taxes.
Gotcha.
So I believe that it's fair to ask these type of questions to make sure that everybody's paying their fair share. So I think eventually everybody's going to have to do it.
Jacques Financial is the website, JACQUES financial.com. This is just a piece of what you offer in terms of direction and insight. With basically anything financial, you've got a great team. You've been doing this for decades, and it totally shows, and that's why you are our professional of the year. Joe, really appreciate it. Thanks for being here today.
Well, again, thank you very much for having me.
We'll be right back. Broadcasting from the business capital of the world, this is the Podcast Business News Network.
Adopt US Kids presents Multiple Choice Parenting.
Your daughter just had her first breakup. Do you A, put yourself in her shoes?
How could he do this to you? And for Sheila, she has split ends.
B, console her?
Oh, sweetie, this is going to happen a lot. 4, maybe 5 more times before you get married.
C, take charge?
Got to get this all straightened out. Give a little talking to, man to man, mano a mano. Hey, Steve! Is now a good time? No? Okay, no problem. Bye.
Or D, help her find a new boyfriend?
I know a great place to meet boys. The internet. Nice, single boys. Never mind. How about some ice cream?
As a parent, there are no perfect answers. But you don't have to be perfect to be a perfect parent. Thousands of teens in foster care will love you just the same.
For more information on how you can adopt, visit adoptuskids.org. A public service announcement from the U.S. Department of Health and Human Services, Adopt U.S. Kids, and the Ad Council.